Okay, Assalamualaikum warahmatullahi wabarakatuh and a very good day. Right, so this video are going to explain the past year on July 2024, question 1 on financial statement. Uh, right, so as we go through the question, this is a question 1 of past year July 2024. You can see that the question mentioned about Jan Berhad. Jan Berhad Incorporated in Malaysia with an authorized capital of 150 million units of ordinary share and 100 million units of 4% preferred share. Right? So the question give you here the things that we are going to highlight. The question give you here the trial balance for year end 31st December 2022. So if you refer to the last additional information, the question also mentioned that the financial statement were authorized for issue by board of director on 31st May 2023. So therefore, the year end is 31st December 2022. So this is the beginning of the financial year, accounting year, 1st of January 2022 until 31st December 2022. And the point number 8, when the question gives you the authorized date, it is 31st May 2023, mean that this period from 31st December 2022 up until 31st May 2023, this is MFRS 110, which is event after the reporting date. So the event after reporting date can become adjusting event or non-adjusting event. This is the point that number 8 gives to you here. Okay. All right, so never mind. We just proceed to information number 1. So information number 1, okay, 1st of April 2022, you see it is within the accounting period. 1st of April 2022, it was determined that the value of the inventory has decreased by 500,000 as the industry now using advanced spare part due to significant technology change. This reduction in the value of inventory has not yet recognized. The value of inventory are decreased by 500,000. So inventory, when we realize, we put inside the cost of sales. In other words, actually, inventory is asset. When it is realized, we want to convert it to become expenses, we put inside cost of sale, right? So therefore, same goes with this one. If uh, any decrease in value, the difference also we need to put inside the cost of sale. So therefore, in this case, the value of inventory decreased by 500,000. So we debit cost of sales and we credit the inventory. The value of inventory is decreasing by 500,000. Right. So information number 2. Okay, the company applies revaluation model for land and building. Okay, the land is not depreciated. Okay, common. The building is to be depreciated annually based on remaining useful life of a building. Right. So the revaluation of the surplus of depreciable asset is to be transferred to retained earning with their remaining useful life. Okay. So again, this information is on when you have a when you have a new revalued amount, the depreciation are going to be higher. The higher depreciation, the difference between the new depreciation and the previous depreciation are going to be transferred to retained earning. Okay, so no adjustment for number 2. So we proceed to number 3. The company carried out the first revaluation of land and building on 1st of January 2022. You see, it is within the accounting period here. At the date, the market value of the land and building were 85.5 million and 102 million respectively. The building had a remaining useful life of 48 years. Okay, the question gives you a remaining useful life. Okay, these were not recognized in the account. So we do one by one here. First, we do for land. Okay, as for land here, we see as for land here, the cost of land is 90 million here. From the trial balance, it is 90 million. So the carrying value, the cost is carrying value. Carrying value is 90 million. And the revalued of fair value given by the question is 85.5 million here. So as we compare, we can see that the cost is higher. When the cost is higher than the market value of fair value, mean that there is a deficit, deficit. So deficit by the difference, 90 million less with 85.5 million is equal to 4.5 million. So how do we want to record this 4.5 million? Because it is decrease, kurang, kan? So it is a cost. So your line are going to be decreased. Credit side. So credit line, debit deficit, which is we put it inside so 4.5 million and 4.5 million. Right. So that's it for land. How about for building? Okay, for building, all right. So for building, first thing first, we need to see what do building have. Okay, so in this case, actually, the building have a cost of 100,000 and a cumulative depreciation of 4,000 or 4 million, 100 million and 4 million. All right. So in this case, the fair value or market value given by the question is 102 million. So we need to compare with carrying amount, right? Because the depreciation is done on the beginning, 1st of January 2022, no need to calculate depreciation for the current year first, because we just need to do depreciation after revaluation, because revaluation is 1st of January at the beginning, right? So we just calculate the carrying value. No need to calculate the new depreciation because the carrying value, yeah, here, the accumulated depreciation is on 1st of January 2022, right? So 100 million less with 4 million, we get 96 million. So now we compare 96 million with 102 million. So we can see that the cost is lower. So the cost is lower, market value is higher. Higher market value, we do a revaluation, therefore there is a surplus. Surplus by the different 102 million less than 96 million is equal to 6 million. So there is a surplus by 6 million. So how to record the surplus of 6 million? Remember, when you do a revaluation, you need to eliminate the accumulated depreciation. So eliminate the accumulated depreciation, debit accumulated depreciation, credit building 4 million, 4 million, and just record the new one, the revaluation 6 million. So we debit building and we credit ARR by 6 million, right? Okay, this for our revaluation, right? So we proceed to the next part. Okay. So the building is not yet finished after we done all these two. Okay. So the next part is the impact on depreciation. What is the impact on depreciation? Right. So basically, when we do a depreciation, we are going to do using the new value. The new value or revalued amount is 102 million divided by 48 years is equal to 2,125,000. So this is the new value of depreciation. The depreciation charge for the year. So that's why this depreciation we are going to put on debit and credit accumulated depreciation. Common lah, common eh. Okay. So what is the impact of this one? The revaluation surplus of depreciable asset is transferred to retained earning with their remaining useful life. What is this actually? Okay. This happen when there is a difference between old depreciation and new depreciation. The old and new, the different are go to retained earning. So by right, actually by right, this is justification. Okay, so depreciation of old depreciation, depreciation of building, the old one. Okay, we take it 100 million less with 4 million, we get 96 million divided by 48 years, we get 2 million. Okay, why do I minus with accumulated depreciation? Because the question gives you a remaining useful life. Be careful. Remaining useful life mean that balance. Balance mean that you need to divide with carrying amount, not cost. If the question gives you estimated useful life, then you divide with cost. But now the question gives you remaining useful life. That's why I minus first, because it's remaining useful life. Okay. So by right, you see here, the old one is 2 million. The new one is 2,125,000. There is an increase in depreciation, right? Increase in depreciation is good or not? Depreciation is cost. Therefore, it is not good. Increased depreciation will affect your net profit to decrease. Decrease in net profit will impact your net profit decrease, impact your retained earning decrease. Retained earning decrease mean that impact your dividend decrease. Dividend decrease mean that shareholder not prefer. So therefore, we need to increase back the retained earning by transfer from ARR to retained earning. So the difference here, 125,000, we take from ARR, transfer to retained earning. That's it basically, this sentence. Okay. So basically, this is the justification. If you don't want to remember this, you think, oh, susah lah sir nak kira depreciation lama baru. Okay, don't worry. Just the ARR, the new ARR. The new ARR is RM 6 million, right? So just divide with the remaining useful life, 48 years. So you are going to get RM 125,000. This is another way. This is another way lah. But the reason why I show you the difference between old depreciation and new depreciation is the reason why it is transferred actually. The reason why it is transferred because you want to cover the extra depreciation here. You want to cover the different or the extra depreciation here. But right, if it is too difficult, you can just proceed to the last one. There are 135, 6 million divided by 48 years, and 135 is straight away transferred to retained earning. That is the reason basically. If you don't want to calculate the old depreciation, just do like the red color pen. Okay, yeah. Next. Right, so next is information number 4 here. Okay. So information number 4, it mentioned here, Jan Berhad replaced a major component of one of its equipment on 31st December 2022. Again, it is still within the year. As a result, company operating setting was reduced, the cost reduced, quality output improved. In other words, actually, the question just to justify that this major component should be capitalized, right? So the old component acquired on 1st of January 2028. Okay, the 1st January 2028. The replacement is on 31st December 2022. The cost of old one is 250,000, while the cost of new equipment is 300,000. Transaction is not been recognized. Plant and equipment depreciate on straight line method 10% per annum yearly basis. Okay, so therefore we try to see here. First thing first, it is plant and equipment referred to this 80 million. Okay, it is referred to this 80 million. Okay, so again, it is acquired from 1st of January 2018 until 31st December 2022, where it is disposed, buangkan. Okay. So by right, 18, 19, 20, 21, 22, you see it is 5 years, 5 years, so that's why it is 5 years here. So by right, the disposal of all component of equipment, how to calculate? All right. So the cost, 250,000, less with accumulated depreciation, times 10% times 5 years, because it is 5 years here. So it's equal to 125,000. So 125,000 dispose, right? Dispose, buangkan, diganti. The question did not mention it is sales for any value. No, it's just dispose. How to dispose an asset? Okay, so we have accumulated depreciation, we have cost. So accumulated depreciation 125,000, dispose. Cost 250,000, dispose. So the remaining balance, the remaining or the balancing figure is a debit side, which is debit equal to loss on disposal. Again, loss on disposal, just transfer to support. Okay, loss on disposal, transfer to support. Okay, then we record the acquisition of new component. New component 300,000. How to record? We acquire, right? So debit equipment, credit cash. Just normal. Debit equipment, credit cash 300,000. So this depreciation on equipment, since the replacement happened at the end of the year, therefore depreciation is not affected because the depreciation is done already during the year. Again, even though the question mentioned it is a yearly basis, but it is the last date, because the last date does not impact the last date of the year is not impact actually. So depreciation is calculated based on the old value. The new value no need to depreciate. Okay, so 80 million times with 8%, 80 million. Where do we get 80 million? The cost, original cost, 80 million times 10% equal to 8 million. 8 million is your depreciation, which is debit depreciation, credit accumulated depreciation. Just a normal depreciation without impact of the new component. Why? Because new component is acquired at the end of the year, the last date of the year. Okay. So information number 5, it is based on this 1st of February 2022, again within the year. The company discovered that the research costs incurred on the previous year and current year, so got to previous year, current year, amounting to 1.2 million for previous year and 1 million for the current year, respectively. The costs were recognized as development costs. We know that when we talk about development costs, it is here, the development cost here, which is we already capitalized due to technological advancement, upgrade, and everything. Development costs are expected to generate indefinite. Indefinite, what does it mean? No need to do amortization. It is indefinite. No need to do amortization. All right. So this is the case. We have a previous year and we have current year. Remember, the previous year adjustment is different from the current year adjustment because current year adjustment we haven't closed or we haven't transferred our expenses to Sofol yet. But previous year we transfer already our expenses to Sofol. That's why the adjustment cannot be made on expenses. Okay. So this is the error. Basically, this is the error for both. Is this similar error here? Debit development, credit cash. Okay. The error is the development itself. The error is the development. So previous year expenses already written off in the support and transferred to retained earning. That's why the adjustment on previous year affect retained earning, not support. Okay. So the cash is correct already, right? So we can sell. No need to look at the correct one. The error is the debit development. It is error. So what is the adjustment? We need to take out from development. So we credit development and we debit. We debit what? So we debit a research cost. Or in this case, we cannot adjust already the expenses. We need to put inside retained earning. So debit retained earning, credit development 1.2 million, 1.2 million. Okay, but for the current year again, cash is correct, development is the one that wrong. So the adjustment is Debit research expense, credit development. You see, the research expense is okay on current year, but cannot record on the previous year because previous year we already write off. All right. So next, number 6, during the year 31st December 2022, Jan Berhad operation caused health issue to some of its employees. Due to this, high probable the company bear the medical expenses 900,000 and compensation claim of 2 million. From the affected employees. So Jan Berhad has taken out the insurance policy, but the insurance only cover 80% of the medical expenses. You see, only medical expenses, compensation claim is not covered. Medical expenses only, okay. So this transaction has not been recorded yet. So to record this, remember, this is the estimation. So medical expenses that we need to cover is 900,000. The insurance coverage is for this is 720,000. Right. So again, this is estimation that we are going to cover. Possible that we are going to pay. The highly probable that we are going to pay. Therefore, it's okay for us to make a provision out of it. All right. But how much provision do we need to make? Okay, so the medical expense itself is 900,000. So we make provision by 900,000. The compensation not yet received, so we put a receivable here, 720,000. Because it is 80% from 900,000, so we get 720,000. The balancing figure is the one that go to expenses, which is support, 180,000. Why? Because we have a receivable. Can we minus the receivable with provision? Cannot. This one, according to MFRS, we cannot minus. We need to show one by one. How about the compensation claim? Compensation claim is easy because compensation claim don't have any insurance to cover. So we just record as provision. Debit expenses, compensation expense, and credit provision for compensation expense, 2 million, 2 million. That, right. So number 7, the tax expenses were estimated to be 3,010,000. Again, as we discussed on the previous one. So tax, I love it to show you on this format. Okay. So this all information highlighted here is tax. First thing is tax paid. Paid is on cash. Okay. Once you put it, I cancel. Once I put it inside somewhere, I cancel. Because all items that we are going to all items show in the journal entry, we are going to use all item in trial balance, we are going to use one time only. Trial balance one time only. Tax payable beginning of the year, put it here, cancel and put it here, payable beginning of the year. Tax expense is Sopol is 310,000. So now you just balance these two sides. 3,760,000. Both sides should be 3,760,000. The balance figure will be payable. So again, how to record this? Payable are going to become your SOP under current liability, while SOPOL are going to become your SOPOL under tax expense itself. Tax expense itself is special, right? Okay, so from this, we proceed to do the financial statement, right? So from this, again, this is all the adjustment that we have. 1, 2, just info, 3, 4, 5, 6, and 7. So 8 just info. So this all the adjustment that I do on the previous slide on the red color box. So I put it here. You see, tax paid and tax payable is already cancelled here. Why cancel? Because we already use it. So once we use it, we cannot use for 2 times. You see information number 7 here. I just take out these 2 only. This all information again. If you are doing in your question or paper or answer as a scheme, this is all you can refer to the adjustment or the notes that you do just now. No need to again take it to another place. No need. I just put it here because not enough space for me to do. All right. So first thing first, we prepare the statement of profit or loss according to the question. We prepare statement of profit or loss. Remember the title, full title, and RM. Don't forget if you want to do RM this. If no, then just no need to put this 30. Okay, it's going to start with sales, debit sales. Oh, sorry, it's going to start with sales. No adjustment for sales, no adjustment for sales. So just put it sales 276. Take it from trial balance and cancel trial balance. Once you put it here, cancel. Okay, next after sales is cost of sales. Cost of sales here is 106 million, but remember you have adjustment in number 1 here. So debit side mean that debit expenses mean that expenses are increasing. See debit here also debit, trial balance also debit, mean that it is increased. So you add up these two, 106 million plus 500,000. So it's equal 106,640,000 plus 500,000 is equal to 107,140,000. Okay. Sales less with cost of sales, you get gross profit. Alright, so then next, put it any other expenses that we have. So any other expenses that we have, other income, distribution expense, finance expense, admin expense. Okay, okay. In this case, in this video, I show you the other method. On the other video, I show you we need to do all these inside one specific working, right? So this one I don't want to do that because again, this is just working. The one that I show you is just working. Okay. In this case, I want to do just put it here. Is it possible? Possible. Yes, can. Okay. First thing first, uh, what do we have here is the other income. So what income do we have in this slide? Remember, income is revenue on credit side. So if you see on credit side, you can see that we have income from investment and rental income. Only these two of the income. The rest, we don't have income. Credit side only, eh? And you can refer in the notes to the account. We don't have any other income. So we just have these two as our income. So I just total up these two, cancel because I put it here, 4 million plus 850,000, and total up become 4,850,000. Right. In this method, I just want to do this as working. Okay. Next, distribution income. Distribution income, from the question, we can see we have a distribution income, selling and distribution here, selling and distribution here. So 19 million 600,000. Okay, I just take it there. I just cancel that. And we don't have any other selling and distribution income, even inside additional distribution. Just one item. So I just put it in the answer. 19 million 600,000. Done. Yeah. How about finance cost? How about finance expenses? Finance cost, we have 2,640,000. 2,640,000. So we see in additional information, we don't have any finance cost expense. So again, it is assumed that, cancel first, it is assumed that it is the same figure, 2,640,000. No adjustment needed. Done. How about admin expense? Okay, admin expense, definitely we need to do working lah. So I just do working here, working number one. Okay, for admin expense, when I do working in this work, right? So therefore, the working is, again, we take from the trial balance here, admin expense, cancel. Once you put it here, cancel. Next, what else do we have? What else, eh? On debit side, right? Debit side, we don't have any other thing inside trial balance. Trial balance is all no expenses. So we see in additional information. So number one, number three, what do we have? What do we have? Yes, depreciation. We have a depreciation here. So we put depreciation on building, 2,125,000. Cancel. Yeah. Good. Next, what do we have? Next, try to look again. Depreciation on plant. Depreciation on plant here, number 4, 8 million. Next, what do you have? Research. Research expense, loss on replacement. Okay, so do loss on replacement first. 125,000. This one, loss on, and after you put, we cancel it. After you put, we cancel. 125,000. Next, what else? Research expense, 1 million. Put it here. Number 5. Next, number 6, we can see that we have a composition expense and medical expense. Medical expense, 180. Composition expense, 2 million. Once we put, we cancel. Then tax, tax only lah. Tax have their own place, right? So that's it. That's it, right? So we don't have any other expenses, right? Okay. How about support here? Support. How about deficit here? Deficit for land is specific. I mean, it is for land. It is not for your administration. It is for land. So I'm going to do this on its own actually later. So I total up admin expense here, 41,960,000. And I put here 41,960,000. As I mentioned previously, deficit on land is special because it is on land. So I put it here on their own place here. Deficit on land is special because they are on land. Land is your PPE, right? And it is deficit because your ARR, right? So that's why I put it there as on its own, 4.5 million. So after you minus everything here, you are going to get a profit before tax by 105,635. Profit before tax, right? So now we do tax. Tax expense, just take it from tax here, tax special, and their own place. Put it here, 3,010,000 minus, you get profit of tax. Then, after profit of tax, this one is the one that transfer to retained earning. The one that transfer to retained earning. However, because we have movement in our ARR, so we need to show here the movement of our ARR. Which movement that we need to show? Movement that impact on revaluation here. So ARR here, right? So surplus on ARR by 6 million. No need to cancel because this one is not for balancing figure. This one just for disclosure purpose. Okay. Again, the one that transferred to returning, this one. This one is not for balancing. This one for disclosure only. That's why I need to cancel disclosure only. All right. Next, we need to do the SOCHI or statement of changes in equity. Statement of changes in equity. If you refer to this question, we have a retained earning, we have ordinary share capital, we have a preference share capital. Oh, sorry, this one is dividend. We have ordinary share capital, we have a preference share, this one is dividend. Retained earning, okay, that's it lah, that we have. Okay, retained earning, ordinary share, preference share, and from the question we have ARR. So we just take it from the question, the balancing figure, and we cancel. After we take it from the question, we put it in the question and we cancel. This one is dividend. Dividend no need to cancel yet because dividend is not yet done. Okay. Next, what is the impact? What do we do next? Okay. Again, because we have a research, because we have a written earning here, number 5, we have a written earning here, right? We have written earning here because there is an error, which is what we call as prior year adjustment, PYA, prior year adjustment, research expense, prior year adjustment here, 1.2 million. Debit mean that decrease your written earning. So you put there as decrease on your written earning here. So minus 1.2 million. So cancel. After you do that, you cancel. Next, profit for the year. I just take it from Sopol. No need to cancel anything. Just take it from Sopol and put it there as 102 million. Next, ordinary dividend paid and preference dividend paid. Again, from the question, try balance. Just take it these two and put it inside the retained earning because dividend is paid using your retained earning. Next, what else? We look here, we have ARR. Okay, revaluation of building 6 million and put under ARR 6 million. Next, what else? We have another ARR here. ARR, once you put here, you cancel it. We have another ARR here, which is you transfer from ARR to retained earning. Both ARR and retained earning are here. This is ARR, this is retained earning because both are here. Both you put here, both cancel because both are here. Okay. ARR is decrease, retained earning is increase. So ARR is minus, retained earning is positive. Increase and decrease. All right. What else? Done. Finish. So finish. Total out everything. We get the answer. Okay, the answer, we are going to use this answer inside our soft PR or statement of profit or loss. But before we do a statement of profit or loss, I would like to suggest to do notes to PPE first. Because notes to PPE is important because we take a total and we transfer to soft pay. So notes to PPE. Again, how many PPE do we have? We have land, building, and plant and equipment. This one just follow the question. Land, building, plant and equipment 3. So we just take a beginning balance first, cancel from the question, put it here, cancel from the question. All right. So any adjustment on cost, we look for the word debit credit for land, building, or plant and equipment. Do we have? Number 1, don't have. Number 2, don't have. Number 3, yes, we have land. So land, we have a deficit on revaluation by 4.5 million. I put here 4.5 million. Next, number 3, oh yes, we have a building by 4 million. Building is elimination by 4 million here. So again, building elimination by 4 million and increase by 6 million, revaluation by 6 million. All right. So surplus 6 million, elimination by 4 million. My elimination credit minus credit minus debit is increased. Okay. So number 3 is done. Number 3, number 5 don't have. Number 6 don't have. That's it, right? That's it, right? So we don't have any more. Yeah, sorry. Got one disposal of this one of your what? Plant here, equipment here, 250,000 disposal, number 4. So we minus under plant and equipment by 250,000. So anything else? Yes, we have this debit on equipment. Debit is increased, cancel, put it here, additional by 300,000. So do you have number 4, number 5? No, okay, done. So total out everything and it's done. Yeah. So total up, total everything. We calculate accumulated position first. Okay, accumulated position. Uh, take it the balance from trial balance here. Beginning balance 4 million and 60 million. Put it here and cancel from the question. Okay, once you put it there, cancel the question. So now you look for accumulated position. Do we have accumulated position? Yes, we have here. We have 4 million here in number 3, 4 million. Okay, number 3. Elimination, 4 million. We eliminate, right? Number 3 just now. And we have number 3 also, the depreciation charge during the year, 2,135,000. So charge during the year. So 2,135,000. Next, do we have other accumulated position? Yes, we have other accumulated position for equipment here. So it is 125,000 for disposal. Do we have any? Yes, we have 6 million here. Accumulated position. So charge during the year is 8 million. Yeah, charge during the year is 8 million. This one, the debit side, credit side is okay. So charge during the year is 8 million. All right, done. Okay. So what else? Total up. We get a total for accumulated depreciation. So cost less with accumulated depreciation, we get carrying amount. So carrying amount, total up everything, we get a total of 241,550,000. So this cost we transfer to our soft P on PP. Just put it there, right? Guys, in this question, I just cancel the one that we already cancel. I just cancel. I did not put in this slide because it is not enough space for me to do the soft P. Okay, so I just put the one that we haven't canceled yet. All right, so for PPE, what else do we have on PPE? We look on the side asset, right? So biological asset, do we have a biological asset here? Yes, biological asset. So never mind, we just do development property first. 4 million. No adjustment, right? Development, investment property, no adjustment. Then what else do we have? We have long-term investment, no adjustment, 20 million, right? So biological asset, 3 million here, no adjustment, all right. Development cost, 3,770,000, but we have this development and we have this development. Credit side, right? I mean that you have to minus. So 3,770,000 minus 1.2 million minus 1 million because the adjustment. So we have the remaining of 1,070,000. So the asset that we have left is inventory, account receivable, and bank. And definitely it is not a non-current asset, it's current asset. So we proceed again for non-current asset. So inventory, again, inventory cancel here, no adjustment, 12,400,000. There is adjustment here, number 1. So credit side, mean that decrease, minus 500,000, decrease. So we have the answer 11,900,000. Next, what else do you have? Account receivable, no adjustment, just put account receivable, 26,845,000. And bank, bank or cash is similar, bank or cash is similar. So bank 15,000. Adjustment is on information number 4 here. Credit. So in that decrease 300,000. So we have a 14,700,000. Okay. What else do we have on asset? Debit side. You see here, debit side all cancelled already. Here is all cancelled already. So now we look on debit side in the adjustment. Is there any debit side? Compensation receivable, we have one more here, compensation receivable. So we put it here, compensation receivable, 720,000. Then debit side is all done. So we total up our total assets here. Next, we calculate for equity. Again, share capital, we total up here, share capital, any other reserve from the previous Sochi. Put it here. In here, I total up orange share capital and preference share capital. If you want to do one by one, also possible. Okay, so this all, we take it from Sochi. All from Sochi. Whatever answer we have in Sochi, we put it here. Next, we look for non-current liability first. So we have a loan, 8% loan and debenture here. Is there any adjustment? No adjustment. Just put it here, right? Then we have current liability next, which is now we have accounts payable. Accounts payable, no adjustment. We just take it there and put it there, 35,100,000. Here you see what item haven't cancelled yet. So we have provision for medical expenses. we have a tax payable. The provision here, I total up both, 2 million and 900,000. I total up both. Put it here as 2 million and 900,000. If you want to do one by one, also possible. So that's it. It should be balanced here. It should be balanced, and it is done. Okay. This one is kata semangat sikit. Kadang dalam hidup penuh misi dan rahsia, yang paling sukar bukanlah orang di luar sana, tapi suara hati sendiri. Okay, yes. Terima kasih.